My target on gold, was 5,000. That's where but I think that may prove conservative. I raised my target back in early October in my fourth quarter letter on silver. I raised that to $100 from 75. And I'm pretty confident we're going to see that in the next, several months. As I keep saying, we're 43 years into a secular bull market at all-time highs or very near all-time highs. The next cycle, those could go on to major new highs. So, I'm calling for gold to go to 20,000. I'm calling for silver to go to 500. So even if you rode through the bear and rode through the bust and bought and held, those things, you will be fine.
The precious metals landscape is moving into an aggressive acceleration phase as long-term structural forces align in ways not seen for decades. Gold and silver have both cleared their historic ceilings, and despite short pullbacks, the underlying momentum remains firmly intact. The miners, after years of lagging, are finally beginning to mirror the strength in the metals themselves, suggesting that the most potent portion of the move may still be ahead. Broader equity markets, meanwhile, sit at levels that mask the depth of risk building beneath the surface, with long-term cycles pointing toward a significant reversal before a new phase of monetary expansion emerges. David Hunter, a macro strategist known for long-cycle forecasting, argues that the current setup places gold on a trajectory toward $20,000 and silver toward $500, driven by a coming deflationary bust followed by unprecedented global stimulus. In his view, equities will experience a severe drawdown before recovering. At the same time, commodities, especially metals, will lead the next multi-year cycle as supply constraints collide with re-industrialization and inflation pressures. Now, we present the clips from David Hunter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
It's been a tremendous run this year. The miners have finally started to catch up to the metals. Gold's done very well, as we know. It's has been up to 4,400, I think. And silver, which had lagged, has done a lot of catch up in the last several months. We've gone through a correction here. You got a lot of people calling for lower prices on gold and silver, lower prices on the metals. My look at it is that we are at that inflection point here too. I think as of today, you may have bottomed out in the miners, and I think there's a big run ahead. I think the biggest part of the run in the miners is ahead. As big as, some of those have doubled and tripled off their bottom, some more than that. And yet I still think the biggest move is ahead of us, and ahead of us in the next 6 months. It's not, 2 years ahead, 3 years ahead. They will get hit in a global bust, which is what I'm expecting after this, sometime next year. But before that, there's big upside in the miners. My target on gold, was 5,000. That's where but I think that may prove conservative. I raised my target back in early October in my fourth quarter letter on silver. I raised that to $100 from 75. And I'm pretty confident we're going to see that in the next, several months. So there's basically silver took a while to get to new highs, but it's finally at all-time highs as well as gold. And I think now there's clear sailing for both of them. I'm pretty sure because of what's coming, it doesn't mean all things are not going to be up at new highs, but the broad indexes, the S&P, the Dow, the NASDAQ, those indexes, I think, are going to be decades before you see the highs that you see in this cycle. So if it's 9,500 on the S&P and you go down 80%, let's round the number. Let's say it's 10,000 on the S&P. You go down 80%, that's 2,000. You can come out of the bottom of this bear market and see the market triple or quadruple off that bottom. So it could go from 2 to 6,000 or 2,000 to 8,000 and still be far below the peaks of this cycle. So it doesn't mean you won't have a cyclical bull market or a money-making opportunity in the indexes. But if you ride it all the way down, that's not going to get you back to even. You're still going to be well below even, I think. And whereas if you're in a more narrow group of stocks that are, let's say, commodities, the next cycle, those could go on to major new highs. So, I'm calling for gold to go to 20,000. I'm calling for silver to go to 500. So even if you rode through the bear and rode through the bust and bought and held, those things you will be fine. You'll just have to deal with the the negative period that you won't feel very good. Your portfolio's gone down, but so it really makes a big difference what you're owning going into the bust, and then what you're owning on the other side of it. In terms of, but I do want to stress, people hear dire things like 80% and never getting back to those highs or not for decades. That does not mean there's not investment opportunities in the next several years. There's going to be some very big opportunities. It's just going to be in a different manner. You're going to have to kind of adjust to the different kind of a cycle that you're going to be in, because it is going to be, what happens is in the bust, the central banks around the world are going to have to respond to the bust with all kinds of money. So similar to 2020, similar to 2008-9, you're going to see massive money, except I think it's going to be 4 times what we saw in 2020. So massive money. It will trigger a rebound. It will trigger a recovery cycle. It will trigger a new cyclical bull market. But it also will trigger an inflation cycle, the likes of which we haven't seen in this country. So if in the early 80s we got up to the 20% inflation, I think this time around we might get up to 25% inflation by the early 2030s. If you see that, that's going to be negative for a lot of growth stocks. So stocks that depend on lower interest rates, it's going to be negative for the bond market. I personally, I think you're going to have a great run in bonds. You could see a 0% 10-year at the end of the bust. But from there, you could see the 10-year go to above 15%, maybe even 20% over the ensuing 7 or 8 years, 6, 7, 8 years. So I personally would consider that 0% 10-year, the top of the bond market, probably that will be the top and the bottom in rates for a long time to come as well. So if you think it through, that means the next cycle, bonds are not going to be a good investment. If the indexes are going to be lagging, they're not going to be a great place to be. And so it starts putting you more towards commodity. And it doesn't just mean gold and silver. It means oil stocks, copper stocks, steel stocks. All the commodities, I think, will do very well in the next cycle. So it means and that's investments if you go all the way back. Every cycle you'd have to be flexible. And what happens to most investors, because they don't understand that, is they kind of ride with the horse that brought them there. And so they don't really change things around. And then the next cycle, the things that worked so well in the past cycle are the laggards this cycle because they're under a lot of distribution. And the things that are the new leaders are the lowest weighted things in the indexes. So they don't really give you the oomph that you want. You have the heaviest weighting things are from the past cycle, and those are laggards, and the lower weighted things are the new leaders. So you have to kind of be a more active manager going into the next cycle is what I'm basically saying. We're coming into some very hard times. If you get this kind of a scenario where the market gets hit hard, home price get hit hard, the economy is going to be facing inflation. And then after that, I think even a depression in the mid 2030s, the best thing you can do is not get yourself caught up in debt. Try to reduce your debt. Try to take advantage of these changes in the markets where you can get into the things that are going to work, and try to get your financial house in order to be able to withstand what I think are going to be tough times. I will say the Trump administration is trying to bring back middle America. I mean, it's been 40 years of very bad policies. A lot of it was the whole comparative economics theory of, send your manufacturing out to the places where you can do it cheapest because, whoever can do it cheapest, that's okay. And then, you make your money here on Wall Street, et cetera. Well, that really benefited Wall Street. The corporate earnings went up, but it gutted our middle class. It gutted our middle America. And a lot of these cities are burned out cities that are, very drug infested and crime infested because people lost hope. And so Trump is trying through tariffs and through these other deals, trying to bring capital back into this country from foreign investors. He's trying to rebuild that as fast as he can. And that's where a lot of the criticism is people see what he's doing. It looks reckless or looks a little chaotic, but that's what happens when you have to do it quickly. We don't have the luxury of decades to do this, which is how it would normally play out if you reverse things. He's trying to do it faster. I think it's the right policy. Hopefully the Supreme Court allows the tariffs to proceed. We'll see. But people need to be patient because it doesn't happen overnight, even if he is doing it quicker than anybody else could do it. But that is the goal, is to try to level the playing field, bring back Main Street somewhat at the expense of Wall Street. He's not trying to hurt Wall Street, but they've had great time. That's why we've got a 43-year secular bull market. But, Main Street's really suffered, and it's been both Democrats and Republicans have allowed this on their watch for decade after decade. And basically, it was the economic theory out there that comparative economics works. If the whole globe benefits from going to the lowest cost producer, then that's what we should do. And unfortunately, that's not how it worked. And of course, there's, it's also not a pure economic model out there. You had China doing what they're doing and, others doing what they do. And, but we've been the marketplace to the world, and it's time to kind of reverse some of that, get the trading deficit down, get manufacturing back here. And that I think is going to be part of the next cycle. Is a lot of why commodities are going to play so well is because we are going to see manufacturing resurgence in this country. But that means building new factories, new plants. That requires a lot of steel, a lot of commodities. And unfortunately, we won't have the supply. The demand will outstrip supply and prices will go through the roof. But if you're there as an investor, you're going to be happy about that.
Market momentum continues to stretch deeper into its late cycle phase as liquidity pressure builds beneath the surface of an aging secular bull run. Major indices still have room to push sharply higher, supported by easing expectations and a temporary surge in risk appetite. Yet the structure of this advance reflects the final stage of a multi-decade expansion, where weakening economic data, rising fragility in credit markets, and deteriorating consumer strength begin to shift the foundation quietly. As rate expectations roll over and long-duration yields soften, capital continues rotating aggressively into equities, amplifying the final upside extension before exhaustion sets in. The transition from cautious sentiment to broad market euphoria is the key signal, marking the moment when liquidity support is mistaken for renewed economic strength. Once that shift completes, the path toward a significant reversal becomes unavoidable, setting the stage for a deep unwind. Let's get back to the interview.
And the Fed seems to be, along with the worry about an AI bubble, the Fed seems to be, right front and center in terms of the thing everybody's most concerned about. It's funny because on one hand, I think the Fed is going to help fuel this run to the top, and I still think there's 40% plus to go. But on the other hand, it doesn't mean it has to, that if they don't cut in December, it's all over. I mean, people get a little too obsessed with the Fed, frankly, and maybe even our president is doing that. But as I say, the bond market will dictate rates. And my look at the bond market tells me there's a big decline in rates coming. Doesn't mean it's right from here, but I think somewhere between or 410 or thereabouts, between 410 and 420 on the 10-year is, I think, the end of this backup in rates. And I think you'll see 3% probably in a matter of a few months. So just to kind of clarify, I am looking for a top in a 43-year secular bull market. So this is what would be categorized as a very major top, and one that will probably stand for decades. So the highs in this stock market of, I'm calling for, which I kind of glossed over, but I'm calling for 9,500 now for the S&P. I think last time we talked, I was down at 8,700. So I've raised that in my fourth quarter letter to 9,500. That's a long ways from here. It's 40% probably from here, basically. And the NASDAQ I raised to 32,000. The Russell I raised to 3,800, and the Dow I raised to 65,000. So all of them have basically 40% plus returns from here to go. With that in mind, it's not a top yet, and even though it can come very fast in this final stage, you don't want to get nervous yet and jump out. But on the other hand, time-wise, we could be at a top as early as sometime in the first quarter. And so you do have to start looking. And what I will say is that we're not seeing the signs here yet, but what I would be looking for is sentiment to be all in. Once you have, as I said, people are pretty cautious right now, and every time we get a little sell-off, they get nervous. Once you have everybody convinced, we got the Fed at our back. The Fed's getting more aggressive in easing. It means the cycle has a long ways to go. It could last for a couple more years. Once you start hearing that rhetoric, that's the beginning of the end. It's not the end, but it's the beginning of having to start say, how long can this run? I don't think it has 2 years to run. I think it has months to run. So, I may be wrong. It may get stretched out again, but that's what I would be looking for, is sentiment to move from this kind of semi-bearish, cautious area to where everybody's convinced that everything's wonderful. And I think that's coming. It's that kind of what we see at top. So we haven't seen that in this cycle yet. I also think that you'll begin to see a much weaker economy. And that's, I think, will help fuel this last run, is as the economy weakens, the Fed's going to get more aggressive on the easing side. They have to start pumping liquidity because they've been too restrictive. And that will initially be taken as a positive for the market. But as the economy continues to weaken, I don't think the Fed's going to be easing aggressively enough to stop what I think is going to be a pretty dire 2026. So that's what I would start thinking about. And you mentioned market timing. Again, I've talked about this in a few of my interviews. From the mid 80s on, the mantra in terms of what the financial industry pushes on the investor is it's time in the market, not timing the market. I would just caution people, that has been great advice. Anybody that just kept putting money into an index fund for the last 30, 40 years has been very thankful of that, and just if they stayed with it, has made a lot of money. There comes a time when a big cycle comes to an end. I'm not talking about the shorter economic cycles, but a bigger market cycle comes to an end. And when it does, and if I'm right that this one's going to be a major top where you could see as much as an 80% decline in the stock market, you don't want to ride that down. So even though, the advice of just buy and hold and markets always go to new highs has worked wonderfully for, as I said, for 40 years, is not going to work well for the next decade, because you're going to get hit very hard if this thing does what I think it's going to do. And then you're going to have to dig yourself out of a big hole, and you may not get back to the levels you were at this year or early next year. So it is a time when you may have to kind of go against what's conventional wisdom right now in terms of buy and hold, and say, I'm going to be out. It doesn't mean you have to be perfect and when you get out, but you're going to have a better entry point, I think, probably end of next year or early 2027. And it will be a different market cycle following this one. Every market cycle has different leadership. This one was led by tech, to some extent healthcare earlier in the cycle. The next cycle is going to be much more an inflation-driven cycle, led by the commodities, led by the precious metals. So you can ride the metals through this, but they're going to get hit too in a bust. In a global bust, most assets are going to get hit. But whereas, say, the stock market might drop 80%, gold might drop 50% or 40%. So it will be a relative performer, but there's still a big hit. So the things that will hold up in the bust will be pretty much treasuries and cash.
Market conditions are entering a phase in which late cycle strength masks the underlying strain building across equities, credit, and global liquidity flows. The current rally reflects the final expansionary push of a long secular trend, supported by easing expectations and aggressive institutional positioning as they continue to chase momentum. Beneath the surface, however, rising volatility pressures, weakening economic signals, and the early unwind of leveraged global trades hint at a major transition approaching. As yields begin to roll over and liquidity injections return, markets may experience one last surge before the structural break becomes evident. This dynamic is shaping a landscape in which investors must prepare for rapid sentiment shifts and a market environment that evolves far more quickly than typical cycles. Positioning ahead of these changes will matter more than timing the exact top, mainly as capital rotates into assets designed to withstand prolonged instability and declining confidence in broad equity valuations. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.